I'd like to ask you, Yoel Mayerfeld, what is the biggest risk?
Sure. Well, I'll answer in a couple of ways. And risk, as I mentioned, from how I was trained in my professional life is really what I'm always first focused on. Whenever we're looking at an opportunity, um, I'm always spending a lot more time on what can go wrong than what can go right, um, because capital preservation is our sort of number one goal. Um, from a, I was looking at my calendar yesterday and saw that we had this podcast, and Robbie, who set this up with you, wrote in the notes that one question you like to ask is about risk. I should be prepared, and I happen to have been talking to a friend of mine that's a CEO of a large real estate company, a public REIT, and I said, oh, I'm interested in what I'm going to say about what my largest what I think the biggest risk in this industry is. What do you think the biggest risk is? And he said, well, for sure, the biggest risk is um, capital markets freezing up, because whenever that happens, it really puts us in a bind, and to be able to borrow, which we saw, certainly after the '08 recession and during COVID. But for me, that isn't at all what I think of as the biggest risk, and I think part of that is uh, our strategy, which one thing I didn't get into is that we are low leverage borrowers, which I think differentiates us. So, even when capital markets are tight, for our lower loan to value needs, usually there's more room for us than for others. Our bankers always tell us they can sleep at night with us better than they can sleep at night with many of their other real estate borrowers. Um, so I just thought that was interesting. I think that would be what a lot of retail real estate or real estate investors in general would say it's the biggest risk. But for us, we're so focused on the real estate and it performing with or without debt. We're really not about the financial engineering part of real estate, which at these low cap rates, I think every real estate investor has had to become somewhat more of a financial engineering trade than a real estate is a real estate great trade, which is where we really try to stick with. Um, so, so for us, that wouldn't be it. For us, really I'll answer on the retail side, which has been the bulk of our experience and our investment. The biggest risk is we can't perform well if our tenants don't perform well. So our biggest risk is these retailers not sort of figuring it out. And right now they've been, our portfolio, the sales that tenants report to us are stronger than they've been even pre-COVID. They're figuring out their integration of bricks and mortar and online. So they're doing that well. But the day that they don't, the day that they let competition like Amazon um, innovate quicker, figure it out in a way that puts them at a disadvantage. That's a big risk to us. We need our tenants to do well. That's on a more micro to the retail aspect. For more of a macro perspective, as real estate investors generally, which is what we are, I would say it's the risk of the unknown after living through COVID. You mentioned insurance. We have what we feel is really good insurance for our portfolio, and thought of every scenario. Um, you know, we weren't covered for lack of rent during COVID when retailers couldn't pay. So I think the unknown is the biggest risk. So the mitigant, I would say, has been our diversification is sort of like the answer for all kinds of risks for investing. And adding multifamily and industrial was a huge help now for COVID, because while our retailers couldn't pay rent during COVID because their stores were closed, um, our industrial properties all paid rent, our multifamily properties all paid rent. So that diversification was huge for during that 3-month period of COVID that helped us sleep better at night. Now, even the retail properties, it was very temporary, and it was a stressful few months when those stores were closed. But um, uh, we deferred the rents for most of our retailers because our lenders allowed us to defer our loan payments. So all worked out fine, but having that diversification was really the mitigant for us globally. And then the diversification, even within our retail portfolio, um, of mixed geographies, mixed tenants for different credits, so that when um, you know uh, the Ascena brands struggled and Dress Barn closed, it was such a tiny percentage of all of our tenancy that it was very easy to move beyond that, fill some of those Dress Barns, and most of our portfolio continued to thrive, so we were okay. So the answer to mitigating some of these risks that I think about continues to be diversification, which has really helped us.